Penny stocks and small cap stocks. What comes to mind? A quick way to get rich? Or something too risky and not even worth your time? The truth is, both of these views are incomplete. Penny and small cap stocks are a fundamental part of every stock market in the world. They aren't just investment tools. They are structural components of the entire stock exchange system. In this video, we're going to break it all down. You'll learn why penny and small cap stocks exist, why they are so important to the market, and why beginners need to understand the market first before jumping in. And most importantly, we'll see how these very stocks can become powerful profit tools later on. So, what exactly are penny stocks and small cap stocks? Penny stocks are simply low-priced shares from companies with a small market value. Small cap stocks are companies that are still in their growth and expansion phase. You'll find them everywhere, in developed markets like the US, emerging markets, and even frontier markets. While their names and the rules around them might change from country to country, their function is universal. They represent early-stage businesses, innovation, and economic expansion. Without them, stock markets simply couldn't grow. Now, you might be surprised to hear that penny and small cap stocks are not optional for a stock exchange. They are essential and perform three critical roles. First, they support new businesses. Think about it. Every massive company you know today started small. Stock exchanges provide the platform for these small companies to raise capital and grow. Second, they increase market depth. The more companies there are, the more participation we see from investors, which creates a stronger, more resilient market structure. And third, they often act as early warning indicators. They tend to react to economic changes, policy shifts, and liquidity movements much faster than large established companies. This is why professionals monitor them so closely. So if they're so important, why do beginners often get into trouble with them? It usually comes down to one goal: profit. A beginner enters the market and immediately asks, which stock will go up fast? Or which stock is cheap? This approach is a recipe for problems. Penny stocks are highly sensitive. They react strongly to trading volume, news headlines, and pure emotion. Without a solid understanding of how the market works, even small price swings can lead to big losses. This doesn't mean penny stocks are bad. It means the approach is wrong. Instead of seeing them as a gamble, think of penny stocks as powerful learning tools and market indicators. They should be understood first, not avoided. Why? Because they show you, in crystal clear terms, how the basics of the market work. You can visibly see how demand and supply push prices, how trading volume creates momentum, and how fear and greed drive decisions. In large cap stocks, many of these forces are hidden behind massive trading volumes and complex institutional activity. But with penny stocks, the behavior is right there on the surface. Learning from them is one of the best ways to reduce your risk in the future. Remember, learning isn't the opposite of profit. Learning is the foundation of profit. With that foundation, can penny and small cap stocks actually create large profits? Absolutely, but only under very specific conditions. That profit doesn't come from luck. It comes from market understanding, strategic planning, solid risk control, and proper timing. History is filled with examples of huge companies that were once small cap or even penny-level stocks. The key takeaway is that these are not hope-based opportunities. They are knowledge-based opportunities. They reward preparation, and they punish randomness. This is why understanding the stock exchange itself must come first. Beginners tend to focus on individual stocks. Experts focus on the market as a whole. Understanding the market means knowing how major indices move, recognizing different market phases like bull or bear trends, tracking the flow of money, and identifying who is really in control of the price. The pros are already doing this. As a beginner, it's what you need to learn. And here's the secret. Penny stocks can dramatically speed up that learning process. So, let's get the perspective right. The message is not, penny stocks are not for profit. The correct message is, understand the stock market first, so that penny and small cap stocks can work for you, not against you. This approach is what makes opportunity realistic and sustainable for the long run. It's about turning a potential pitfall into a powerful tool. And for those of you who are serious learners, here's a high-level insight. Penny stocks reveal who is controlling the market much faster than large-cap stocks. In large stocks, price movements are slower, and the entities pulling the strings are often hidden. But in the world of penny stocks, shifts in liquidity are obvious, and market traps are much easier to spot if you know what to look for. By understanding the game in this arena, you improve your understanding of the entire market. In the end, penny stocks are not insignificant. They are not shortcuts. And they are definitely not meaningless. They are amplifiers. They amplify knowledge into opportunity, and they amplify ignorance into loss. If you truly want to understand the stock market on a deeper level, start by understanding how penny and small cap stocks behave. They hold the keys to so much more than you might imagine. Thanks for watching, and if you found this helpful, be sure to follow for more.